Cool. Welcome, everyone. My name is Jonathan Vasquez. I am your host. So it's going to cut us off guard a little bit. Quick intro about myself. I am the host of The Home Run. I am a product manager at Beeline. So I work on all the technology that powers our lending experience. And if you've seen this slide many times, you already know I'm very passionate about ocean conservation and scuba diving and hiking as well this summer. So I won't talk too much about myself. Today, I have a very special guest. I love always finding ways to save on taxes. Tony is an expert in this area. I am going to give him a couple of minutes to introduce himself after I go through our disclaimer. So let's talk real quick about our takeaways, and then we'll get started. So today you should expect to learn the tax difference between a primary home and investment properties, basically how your primary is taxed versus your investment properties, how to keep your bookkeeping clean and streamlined for tax time, what are some common mistakes to avoid as a real estate investor, and then we'll talk about what's going to be probably my favorite topic, cost segregation and bonus depreciation. I know that's a hot topic for a lot of people, and not a lot of content out there to talk about it. Quick disclaimer, the content of this presentation and any other future broadcasting is for informational purposes only and does not constitute financial or mortgage advice or tax advice. Please consult a licensed professional for your specific scenario before making any decisions. As always, Q&A is on the right side. You should see it there. Please start dropping your questions. I am anticipating a lot of questions. So make sure you get them in early, because if we run out of time, then your question will just sit there. We will not be able to answer it. We're on a very tight timeline today. So with that said, let's roll. Let me hide the slides. Tony, welcome.
Oh, thanks for having me today. Yeah, this is fun. Appreciate the opportunity to just kind of help educate the folks and hopefully get some good questions, drop some tax saving advice for everyone. But yeah, just a little bit about myself. So Tony Hoong, the CPA Dude's our brand name. My girlfriend came up with it. It was just kind of reflects my personality. More CPAs are, more just prim and proper, and I'm just a very laid back dude. So that's how the name came about. And then we're like a tax planning and tax preparation firm ourselves. I'm personally out of near San Francisco, and then my team's all over the place, Idaho, Texas, Florida, SoCal. So we're all over the place. We're all remote. So I just, some principles of why I started up the, tax practice was just to, the things I didn't like in corporate. And one of those was just, office every day. And I was just like, hey, it's 2022 COVID times, everyone works from home. So we don't have offices ourselves, since I just don't believe in that. But yeah, we work on a variety of clients, a lot of them from, the real estate niche itself. There's tax codes written in just a couple of good ways: real estate, small businesses, investments, right? Those are, how they wrote it. So you got to play by the rules, right? But yeah, take advantage of it. So we'll dive into some of those today. And then, any questions, feel free to throw them in. I'm hoping that it's, we got our own items we want to talk about, but really love to, help everyone that's on the call today and, serve some value for them. So anytime, Jonathan, you think it's a, stop for a good question, just let me know. I'll probably ramble on forever.
No, fair enough. We'll wait for them to come in. We have no questions yet, but I see a lot more people joining. We're actually about to break the record for attendance for this webinar series. So that's going to be really interesting when the questions roll in. But let's go ahead and jump right in. Let's start with the basics. High level, what are the benefits of real estate investing when it comes to taxes?
You won't pay any income tax on your rental money generally. So after interest, repairs, management fees, and then the biggest one, depreciation, you won't pay any, taxes generally. The reason why is because depreciation is a non-cash expense. So, the useful life of a property is 27 and a half years. So say if you bought, $400,000 unit, extract out the land, of course, because land's non-depreciable. Common mistake out there. So if you're turbo taxing, make sure you extract your land value from your purchase price, because you can't depreciate land. It's a common common, thing that, I see missed when like, I have some TurboTaxers come to us because they're like, oh, my real estate portfolio is more complicated. Can you help me out? Or I just don't have time. Generally, it's one of the two where like, more money, more problems, or it's just like, I don't got time. It's generally why anyone, reaches out to a CPA. So yeah, that depreciation though, that's going to be your non-cash expense. And then that's going to be carried forward into the future years. And you keep on using that 7, 8, 9, 10, however much you bought that unit for, non-cash expense reduced down to zero. And actually the whole goal is actually go negative, right? Because you'll keep on carrying those losses forward. So you're going to be, cash rich because you didn't pay taxes on it, but you're going to be tax broke. So that's like why the real estate's way out. I mean, I'm invested too, try and get more into more different deals. We tried to get into a deal with a mobile park home. That one looked lucrative, but it was like hard because of like, wait, we can't depreciate land. That's the only asset. So it's like, oh, it was actually a cash rich on a tax side too. So, tax-free income pretty much. And then the other big part, we'll talk about later too, is the short-term rentals. There's a big, you can pretty much you can probably get your down payment back with the short-term rental hack with bonus depreciation. So we can dive into that later also. But other than that, just real estate, you can have when one of your spouses goes towards it. So generally I see in the Bay a lot, you have one tech worker and then you got one, stay-at-home spouse. And then that person becomes a real estate professional. And then boom, you create all these rentals, that person's real estate professional, and you get money back from that W-2 income. So, that depreciation is really important, but there's a few quirks that you have to play within the rules. Those few quirks, we can go over that right now. Is that first one is like, hey, rental losses, how can they be used in your advantage? So the first one is the easiest, is if you make less than $150,000 adjusted gross income. So it starts phasing out at $100,000 by 50 cents. So it's washed away completely at 150,000. But say, for example, you made $100,000, and then you had, say,
$100,000 in rental income or just income in general?
W-2. Yep.
Okay.
Yep. So you make 100K from your day job. And then say you have one unit and you picked up, $5,000 of a loss from it because of depreciation, all your other expenses. Okay. That 5,000 will actually reduce your 100 to 95. Okay. So because of just, being a smaller taxpayer, right? So then 95K is now your taxable income. So if you kind of say, if you're generally 25% tax rate between federal and state, that 5,000 times that 25, you just 25%, you just save that much more money on taxes. So you're getting a little bit of money back on your rentals. So that's number one that you can do, is just make less than $150,000. You got some losses, you can offset your income directly. And then number two is that real estate professional status though. This one's a lot harder to get. So be wary if you're a real estate professional checking it out on TurboTax. You more likely than not will trigger yourself an audit if you're working W-2. So real estate professional status for everyone here means that, by, kind of the name, that's what you do pretty much full time. So it's more than 750 hours and also more than 50% of your time. So if you're working W-2, like full-time job, you're more likely than not a real estate professional. But the hack is usually, one, you dive full into real estate, or two, you got a spouse who's like a stay-at-home / does this, and that's their profession. And what that does now, you're not limited to $150,000 cap. You can have $1 million of W-2 income, $300,000 of losses on depreciation, rental losses, and then your taxable income is only $700,000. So that's, generally a lot of people that do it, the real estate, they're, the realtors, right? Property managers, self-developments, those are your biggest ones that I generally see that we take for our clients. You can always invest in K1s too, but generally they're going to be limited unless you're a general partner there also. So that's the real estate professional way of having your bonus depreciation in general offset your W-2 income. And then the last one, this was probably the juiciest one as of right now, is the short-term rental. And then the short-term rental loophole is that, you get onto Airbnb, VRBO, whatever you call it, right? And you rent out your unit less than 7 days per period. So maxed amount of days that you can put on Airbnb is 7 days or less. And then you have to material participate. And generally, like there's two prongs where people meet this. It's like you spent 500 hours on the property, or two, you did 100 hours and no one worked more than you. So you can't have a property manager. More or less, you're doing all the work. And how this works, though, is this is the big one that we've shifted a ton of our clients into, is that say you buy an $800,000 unit, you bring in bonus depreciation. They say, hey, you separate it out. I think there's $300,000 of bonus depreciation separated between 5 years, 7 year, 15-year property. And then boom, you take the $300,000 against that year. So W-2, you withheld maybe $60,000 in taxes. You write off 300 grand, you're getting all your tax money back that year. And now you funded your down payment. So those are three main ways. Is the recap is that make less than $150,000. Two, you're a real estate professional. Or three, use the short-term rental loophole. So those are some big benefits from the real estate side that we've been pushing our clients to use, just because it's like, you're always trying to see what other ways can you invest? What other ways can you invest? There's this one that's like, it made the IRS Dirty Dozen list. And it was land conservation easements. And what this was is that it's a partnership. You threw in like 20 grand, right? And they collected this from like, ton of people. So they went in, you put in 20 grand, this person did 20, whatever how much you want to put in. And then the valuations came back at like 5-10x the value. So then they like bought this piece of land, donated to the government because they appraised up so high, donated to the government, and you get 5-10x the multiple. So your $20,000 investment just became a $200,000 charitable contribution because you just donated that land to the government. So that one was good until, people used and abused it. Everything is good until, it's exhausted. So that one, be wary. It's still a good play. Don't get me wrong. Just how aggressive is that firm using it from a real estate side?
Mm-hmm.
Yeah.
That makes sense. I have so many questions just from the answer you just gave me.
Yeah, let it rip. Yeah.
Right. Let's dive a little bit deeper into this short-term rental loophole. You mentioned the bonus depreciation. Is the bonus depreciation benefit only applicable to short-term rentals, or also to more traditional investment properties?
Oh yeah. Oh, I think I jumped the gun too fast. So how do you get bonus depreciation? You have to have a cost segregation. So we can just dive right into the cost segregation part too. Oh shoot, am I frozen or no?
It froze for like 2 seconds.
I was like, oh no, not again. Not again. Yeah.
All right, so you need cost segregation first. Okay, so hold on. Sorry, before we get into that, I got to ask you about this. You mentioned K1s.
Yep.
All right, so let's say I work in tech, I make over 100K, or work anywhere, I make over 100K.
Yeah.
I'm using that as a baseline because I feel like that's where you get to where you really start to get hit on taxes big time.
Yep.
If you participate in a syndication, let's say you put in, let's say you're a 20% owner of the syndication, right? Because of the money you put in. Syndication has paper losses year one due to depreciation. I think I'm jumping the gun now. They lose, let's say you put in 20K and they lost on paper 20K because of the cost segregation. If you're not a real estate professional, and again, you're not materially participating in that syndication, you're a limited partner, can you write off this 20K from your income?
Yeah, if you're at that $100,000 mark. However, you would be capped on so if you made $150,000, you wouldn't be able to write off any of that 20K.
Ooh, okay.
Yeah, but if you're in the middle, so let's use a round number, 110,000, right? This is that phase out. So you lose 50 cents on every $1,000 once you're past 100K. So on $110,000, so we're $10,000 over, you lose 50 cents. So you lose 5,000. So your 20,000 that you're trying to write off, you can only write off 15,000 now.
Oh, okay.
Yeah. So it keeps on going until you hit 150, and then boom, you're cut off. You get nothing. But the beauty of it is that, hey, you paid no income tax. Hypothetically, you get some money back, but then you just have a bank of that $20,000 to use in the future.
How long can you use it for? How long can you keep that in your back pocket?
Oh, forever until it's used up. Yeah.
Really? Okay. So if one day I just decide to leave my job, leave W-2, and I don't work at all for a year.
Yep.
Or I have lower income that year because I left halfway through the year, I can then use the losses from 10 years ago.
Exactly.
Right off the income tax that they paid this year. Okay,
Yep.
that's interesting.
Yep.
Gotcha.
Yep.
Well, I love that idea. All right, sorry. Let's go back to I guess, should we talk about depreciation and then cost segregation, or
We'll go the other way around. Yeah.
Okay, let's go there then.
Yeah. So cost segregation, just so for everyone that doesn't know what a cost segregation study is. So cost seg is the shorthand name for it. But essentially, so by default, a residential rental house, single family home, has a useful life of 27 and a half years. This is what the IRS has called it. Don't ask me how they came up with 27 and a half years. And they say the whole thing has to be depreciated over 27 and a half years. However, we know that the floors, the cabinets, the doors, they're not all going to last 27 and a half years. They have smaller lives, right? And so there's 5-year property, 7-year property, 15-year property. And what a cost seg study does is that it analyzes the whole house, see what's 5-year, what's 7-year, what's 15-year property. And what you do is you extract it all. So now you had, say, $100,000 was the original value, but then we extracted, hey, 5-year properties were 5,000, 7-year properties were 7,000, 15-year properties were 15,000. Now you can depreciate over these faster life cycles and you accelerate your depreciation faster. So that's what a cost seg does. So essentially all it does is puts it in buckets, 5-year, 7-year, 15-year buckets. And then of course the 27 and a half year. So now that you have these buckets, the buckets get used up faster because they're smaller, right? 5-year gets used up faster, 7-year, 15, 27 and a half is long. So you have these buckets to use up faster. So even if you don't run bonus depreciation, you'll still get faster depreciation. So that's accelerating your depreciation. And that's how that's one strategy that you can use. You do always want to weigh out the cost benefits though, because these studies, they're like $2 to $7 grand I've seen. Like it varies on the property, of course, like how intense is it? Is it 4 walls and there's nothing? Like it's not going to cost a lot. If it's 4 walls with like divisions of 4 units inside, it's going to cost you a lot more. But you always want to weigh out the benefit to it. So that's the cost segregation. And one, you can just use it normally. You just want to make sure that, hey, you're not going to pay any income tax on your properties. Generally, when you have one property that's like near profitability, you stack on a cost segregation with a new property. So then you take property 2 to bring down property 1, so you don't pay any income tax. So that's the general method here. And how bonus depreciation works with it is that you do a cost seg study, and then you take 5, 7, 15-year property. And what bonus depreciation is that it allows you to write off everything in the first year that you placed it in service. So, but it only is applicable for 20 years or less useful life property. So what that means is that, of course, the building wouldn't work. So that's why you have to do the cost seg. You separate it into 5, 7, 15, bang, wipe it all away. And that's how you do a big loss and you pay no income taxes on your rental properties. So that's like the cost seg paired with bonus. And, bonus depreciation is used throughout, not just real estate. It's meant for a lot of investments back into the economy, hence why they created a tax law. So generally all your heavy machinery that you're buying, construction, cars too, right? Buying more cars, putting them back into it. That's generally how people are talking about writing off their cars too in the first year. So that's how you pair the two. And then the third kicker to all this, so we got cost seg, we got bonus depreciation, and now, so bonus depreciation though, it's going to create that bank of losses again, right? You're going to have another $20,000, $40,000, $60,000 of losses. How do you unlock it, right? Unlocking it is only 1, 2, or 3, what we talked about earlier. 1, make less than $100,000, $150,000. 2, you're a real estate professional. Or 3, short-term rental loophole, right? So you get the short-term rental loophole. That's generally where it's all paired in with, because then now you paid down, I don't know, $80,000 to $100,000 of down payment. You're probably going to see that much back, maybe 50 to 100K, depending on how much the unit is, of course, back in your taxes though. So then your down payment is more or less free. So that's how a lot of people are taking advantage. And the tricky thing now is that bonus depreciation is starting to phase down over the next 5 years. So this year you still get 100%. So right now, like at Quick, But next year it'll go down to 80, following year 60. It's going to go down 20% every year until it's completely gone to zero. So that'll be interesting to see. I have that feeling that by the final year or two, they're going to revive it. It's just been the traditional way of real estate of like everyone uses bonus depreciation with cost seg. So I don't see it going away, but it's slotted right now per laws. It is. It's kind of like the low income housing tax credit and the new markets tax credit. Like they only have like 5-7 years until like they keep, and then they're about to die, and then gets renewed in the green bill like every time it's about to die. So I'm like, more likely than not, I feel like it's going to come back, but I'm not a fortune teller, so pretend or just like make sure that you play by the tax code of how it's written, and don't bank on bonus depreciation coming back, in 5 years because, some dude on a podcast said so. Right. So just note that. So take this year advantage next year. And if you don't take advantage in the next few years anyways, it's fine. I mean, you still get some bonus. You just won't be able to accelerate as much. So that's one thing for how that cost seg, bonus, and then short-term rental, all those three link together. So I know that's a ooze of stuff. Anything that this was like, oh my gosh, like over the head, or more questions, Jonathan?
Yeah, so we actually got a couple of questions from the audience that tied right into this, and then I want to layer something else on top about remote investing. So,
okay.
So the first thing is it just says less than 7 days. So earlier you mentioned that for the short-term rental loophole to be applicable, you needed to rent the property for less than 7 days at a time, yep. Correct? Mm-hmm. And then it was for 50% of the time that you rented, or the whole year?
It'd be the whole year. So you can't just say, hey, I'm going to put this on for, 7 days or less. And then you're like, oh man, these Airbnb folks are just ruining my home. The cleaning fees are expensive. And then you're like, I'm going to go back to month-to-month rentals or 1 year leases. So it has to be the full period.
Okay.
Yep. Mm-hmm. Mm-hmm.
Gotcha. Random. So what if you list it for say like 2 months and you get a lot of less than 7 day bookings for that time, and then you delist it? Does that automatically disqualify you?
It would be a very super aggressive position to take. You could probably get away with it if you did it November, December, the last 2 months of the year, because then you can say, hey, for this tax year, I'm a calendar tax year payer. I did it, wasn't for me. All right, now next year I'm just going to turn it into a long-term rental, midterm rental. So it could work, but don't do it like in the middle of the year. It just doesn't help your case, because once like the IRS sees like 100K plus coming out for depreciation, it's gonna be like, oh, what's this? Like you do want to have your ducks in a row when you execute this strategy. So just having it documented from the cost seg, having that done, to your hours documented, reps tracker is what we generally tell people to use. You can document it in your own spreadsheet too. You don't have to use a professional tool, but I just like the how it's a third party app. And then, most auditors, if they're auditing it, it'll be like, oh, it's a third party app. It wasn't like a spreadsheet that was just created because you got audited. So having that, and then also just your listings too, screenshot your listings from when you first listed it to the end of the year, just periodically, even through the month. So a lot of it's just like documentation is the biggest thing. Like no one cares about documentation until like the audit comes.
No, for sure. I've definitely been there. So, so I do want to talk a little bit about documentation, but let me make sure I get to this question. So the other question that's related to this is about. By the way, can you see the questions? I don't know if you can see them on the right side. This question would like to hear what would be needed to prove material participation on short-term rental investment property, such that passive losses may be applied towards W-2 income. So basically, how material participation.
Oh yeah, documentation. Yeah. So there's 7 different prongs that you can hit with this, but the main 2 that our folks use is working 500 hours or more that year on that unit, or 100 hours on that unit and no one else worked more than you. So you can't have essentially can't have a property manager because you're the property manager yourself. In terms of, let's see, proving it. So proving it is one that reps tracker, or that spreadsheet that documents the day, what you did, how many hours, any receipts with that property that you conducted for. So say you went and did the cleaning, right? You go in and out, bought some Bounty towels, some detergents, documenting that, having all your receipts in line with it also. So just every time you buy something, just have the receipts ready to prove it. Bank statements will not work. I've seen that, like, there's some auditors that take it, but like some just shut it down. They're like, oh, I got the bank statement, credit card statement. They're like, nope. It's weird. I don't know like why some take it, some don't. So I'd for sure have that receipt. And then the hours is the big thing, either 500 or to the 500 or the 100 hours. And then screenshots of your listing. How do you prove out you did it 7 days or less? So screenshot from the day that you did it. And then every month, every 2 weeks, depends on how risk adverse you are. But I would say at least every month. And then just having that activity log, from Airbnb, like when you changed it, if there's anything of the sort. And then if you're going to do the bonus depreciation with the cost seg, obviously having that cost seg done right, attaching it, if it's applicable, doing your change of accounting method. So filing the correct forms that way. And then Schedule E. I see it done on Schedule C a lot. So Schedule C are for sole proprietors. So a lot of sole proprietors do it like, put on Schedule C because I think it's like a business, but 9 times out of 10, it should go on a Schedule E. The reason why you don't want to put on a Schedule C is that generally Schedule Cs are reserved for day-to-day activities that you mostly do. So there is that 10% where people, that's all they do is short-term rentals, Airbnb arbitrage, like legit put it there, don't get me wrong. But if you're just doing one unit, you got a day job, Schedule E. So that's kind of like making sure you report it on the correct form if you're going to DIY this. And then Schedule Cs are just they're just prone to audits also. It's just it's just the easy way for the IRS to come attack. And then this whole blur of news of 87,000 new IRS agents. But that was funny. I just saw this past week they can't hire anyone. Like there's no talent out there. Like no one really wants to do taxes anymore. Like I got just young professionals, like 18, 19 years old, like brand deals alone, they make 100 grand. I'm like, why wouldn't you do that life versus just doing taxes and accounting? It's just not as juicy as a career anymore.
I have some thoughts about like why would you you have to be very passionate about taxes, I think, to go want to work for the IRS auditing people.
Yeah,
but that's not the companies. I just throwing that out there.
Yeah. I'm just like, oh.
All right, so we got a few more questions that are related. All right, so repair expenses. Can repair expenses on an investment property also be reduced from, or I guess can also be used to reduce your taxes from your W-2?
One, if it is an investment unit, and 2, if you meet that under $150,000 of AGI, you're a real estate professional, or your short-term rental loophole. So it's 1, investment. 2, do you meet one of those 3 prongs? Then yes. It's a big if-then statement.
Yeah, I mean, a lot of these are going to be very, I would say, it depends type answers. Just looking at some. Also, I would say for those that are still dropping questions, if you put the location, that might help narrow it down too for the answer. Because obviously tax changes not only from state to state, but sometimes from county to county. All right. So here's another question. If I bought 2-part question. If I bought an investment property 2 years ago and only did regular depreciation since buying, is there a way to switch to bonus depreciation?
Oh yeah. That's where you do the cost segregation study. And then also that year when you file your taxes, you have to file, I think it's the 3115, but it's called a change of accounting method. And this is alerting the IRS saying like, hey, I'm no longer going to do 27 and a half years straight line depreciation. I'm actually going to switch to, change it to 5, 7, 15 years. So yeah, you can definitely do it from a cost segregation. Bonus wise though, you can't do it after it's been placed in service, but you can always change how fast you're accelerating depreciation. So it's a good second place, I guess.
Okay. Then the follow-up to that is, if I have a second home purchased years ago, that I am converting into a rental, can I use bonus depreciation once it gets put into service?
Yeah. Yep. You can do that because then you're placing it in service, and bonus depreciation is when you're, buy and put that asset in service. So that'd be good. I would watch out though if you don't like, because you might want to take advantage of the homeowner's exemption. So that's if you lived in that house for 2 of 5 years, and if you're single, you get $250,000 exemption. If you're married, you get $500,000. So you may or may not you want to take that into consideration. It's just always like, hey, because primary homes have that special homeowners exclusion that you don't want to lose out. Because I mean, as simply as in like in the Bay Area here, it's crazy. Like you could probably literally just buy a house, live in there for 2 years, move it to your next one, make your equity, and head out, all tax free though. So it's common. I've had a couple folks that actually do it. I'm like, nice, like taking advantage of the code here.
Yeah, I know a few people that have done that as well. They've been getting into better and better houses, but also they don't put all the equity into the new house, so they're just building a lot of cash for other things.
Yeah, exactly.
Now, question on that though. So if you own a primary residence, let's say you live there for 11 months, right? You're about to hit the 1 year mark.
Mm-hmm.
You're nowhere near the 2 year mark, so you can get it to 250K. At that point, if you decide to start using it as a rental,
Mm-hmm.
can you now start can you use, let's assume that happens this year, can you now apply bonus depreciation for year 2022?
Bonus depreciation, if you changed it into a rental and that's like your plan, like you're not just dabbling out just to go get the bonus, then yeah. Mm-hmm.
Okay. What if, like, what's the requirement? Do you need to have it like leased before the end of 2022, or you need to have it listed for rental before 2022?
You would want to place it in service. Yeah. Actually have it like rented out.
Rent it out. Okay.
Yep.
So
Mm-hmm. Mm-hmm.
leased already.
Yeah, because what happens is that you're going to show a big expense with zero income, and that doesn't look good.
Okay. That makes
Yeah,
sense.
because let's say if you rented it, you put it on rent and you put it on Zillow, but then like when you go do your Schedule E, it's like $0 of income because it didn't get rented until January 1st, and then you're trying to write off 20,000, then it's not going to look too good on there for you.
Gotcha. That makes sense.
Yeah. Mm-hmm.
Cool. Sorry, just trying to combine some of these questions as well. All right, here's an interesting one. Well, actually, let me ask a good question. So for remote investing, we did a whole session on remote investing like 4 weeks ago now. Like, what are some considerations for people that are buying, especially buying out of state? If you're in California, but you're buying in Texas, for example, right? Where in Cali you have a state income tax, but in Texas you don't. What are some things that people should consider when doing that?
Oh yeah. So this one, the biggest thing is that if you're doing remote investing, then you're making sure that one, you file that other state's tax return. So say I live in California, but I'm going to, well, Texas, you don't have state income tax, or Florida, no state income tax. So you don't have to file anything there. But say if I invested back in Minnesota, making sure that it's sourced correctly. So sourcing your income to the right state and not having it double taxed. So say if I generated $10,000 of rental income in Minnesota by living in California, one, filing the Minnesota non-resident return, and then two, California return, and then making sure that $10,000 of income, there's like taxes paid to another state credit. So making sure that that's how you offset your income. So making sure that generally states have reciprocity, so you're not double taxed. So making sure that you trigger that, because I've seen that a lot where some folks have came to me and they were on TurboTax, and a lot of like people that have multiple states, and then they like source it all to those states and they just double tax the crap out of them. And they're like, wait, something sounds fishy here. Like, should I be paying this much in tax? So that's making sure you have that happen. And then another part too is like when you get into investments, the K1s, those will generate non-resident state returns also. So that partnership could be in like 4 or 5 different states, and now your tax filing complexity just got it increased by a lot. So that's another thing to watch out for out of state investing. And then other than that, if you're just doing more traditional, like, hey, single family home, multifamily, the LLCs, where is that formed at? Generally what we always tell folks is, hey, have the LLC within that state that you're investing into, not in the state that you live into, because technically you should be filing. So say if I live in California and I start an LLC for my rentals in Georgia, and then I would have to file a foreign corp in Georgia, telling Georgia that, hey, my California LLC is doing business in your state. So instead of doing that, it's just easier just to go to Georgia and be like, I'm just getting my LLC here.
Okay, that makes sense.
Yep.
Question. So that's interesting. You brought up LLC and doing the foreign LLC.
Yep.
There's like a very fine line between taxes and the legal aspect, like the entity formation and liability protection of real estate.
Yep.
This is more about your practice. What do you do when you have to work with clients that have a lot of questions that are more about legal and maybe asset protection, but they like overlap a little bit with taxes? How do you handle those situations?
Oh yeah. So I actually work closely with an attorney over in California. So he's become like a good friend of mine just because I get so many of these questions. So I generally ask him, like, if they're legal related, I always just send it over to him, and then after that, if it's tax related, I'll just tell him the tax answer. But generally, in the ideal state of things, I would consult like both your CPA and your attorney, unless they're like a tax attorney. Then you get the best of both answers, because like my answer may not be the best legal answer. Like my answer, like I only know it enough from a tax perspective to like tell folks of like, hey, should I do the Wyoming LLC that owns like the Georgia LLC? And I'm like, I don't like that strategy myself. I'm like, just put it in where you're at, because like my thing's always like reduce costs and then keep it simple. And then from a tax perspective, because like tax wise, having LLCs owned by yourself does not change if you didn't have an LLC, but you're losing the asset protection. And if you're like have enough money to invest, you definitely want an LLC, because generally that means you have savings, you probably have a home, like you have assets to lose, I guess. Because that's another common question, like, do I need an LLC? And I'm like, how much do you have to lose, right? So if you can't afford to lose everything in the 401k and your home, then probably get an LLC for that property, and then actually do it right. Though I see a lot of like bad legal Zoom ones that are done incorrectly. So just be wary of like how you're forming it. But yeah, a lot of questions do end up in Davis's spot. And I was like, yo, man, you got this one. And I'm like, all right. And then like tax wise, I'll just tell him the tax implications.
Gotcha. Makes sense. Yeah, there's a lot of bad legal advice out there on YouTube.
There is a lot of bad tax advice out there too. I'm like, oh boy. Yeah.
All right. So I know we only have like 13 minutes left. So let me see if we can capture more of these questions. All right. This one is interesting. So this is about seller financing. They're looking at selling a vacation home. I'm going to paraphrase a little bit. How will capital gains be recognized if the seller provides the loan to the purchaser on installment basis? So I'm understanding the question. Let me know if you understand it differently, but I understand it as I'm selling a vacation home. I'm doing seller financing, right? But I'm going to make some money. So let's assume they're going to make 100K on this property, or they're going to make 300K on this property profit if they were to just sell it outright, but they're financing. So what happens to capital gains?
Yeah, this is actually a way to reduce your taxable income. So there's actually installments, like you're paying taxes on installments. So say if you're doing seller financing, you're doing 30 years, and generally that first year, from the ones that we see, they have like some down payment of some sort. It's pretty small. So you pay the tax on that, but then you prorate all your interest payments, because part of it's return of principal, which is non-taxable, and then just the interest income. So say if it's $300,000, and then you say if it's a 30-year loan, right? So you just pay that over the 30 years. So you wouldn't pay the full 300 this year. You just space it out. So that would be preferable, because sometimes people sell properties and they don't want to pay the huge capital gain. I'm like, hey, can you just finance this out? Because then you only recognize it when cash. Because generally taxpayers are always cash basis unless you have a business. That's when you're accrual basis. So if you only got $10,000 that year, then you only recognize $10,000. But part of that $10,000 is interest, part of it's principal. So maybe like $3,000-$4,000. of taxable income for you. So it's a good strategy to have. And then hopefully you're making some good like 10% interest or something.
That would be amazing. And most people that do this usually end up asking the buyer to refinance after like 4 or 5 years anyways and get their own. So that works out. Okay, this one is really complex and I'm not even sure how to read this. Okay, so I am building an ADU behind my primary residence. If I create a condo regime for the 2 units, can I sell the front unit and take the 250K capital gains exemption, move into the back unit, and then sell that one after 2 years and get a second 250K capital gains exemption? I would assume that it depends on how that land gets split as well.
Yeah, that land and the address too, right? So I'd say like, hey, if it's 2 separate addresses, you could probably get away with it. But if it's just like non 2 separate addresses, it'd probably be aggressive. But it makes sense at a high level. I probably would dive into it in terms of like how's it, because I'm assuming like I'm not sure how exactly the zoning works for it, but like from the city, is there like separate meters, separate water, like separate sewer? Like if it's all separated, pretty much can be argued that it's a standalone unit. I think you would have definitely a basis to take, but would probably firm up with just like your CPA, or we can like dive into it and like see if there's any court cases. Generally, like when we like are unsure about a position, we'll just like see, hey, was there a former court case that can support it? But those would be some facts and circumstances that you want to prove out. It's like how much of it is truly a separate unit, and then if you can document it, then I'd say you probably have a good position to take.
Gotcha, makes sense. Yeah, like in my area, you can't even build an ADU. So. People try to put tiny homes in their backyards for like their parents and stuff. They can't. So.
Oh wow.
Well, even RVs give you issues. So definitely consult with the city. I think it's a quick one. If you have a real estate license, does that qualify you as a real estate professional? So you can deduct short-term rental losses.
Yeah, short-term rental, long-term rental, mid-term rental. You can deduct it all since that's actually your career. But one thing that would recommend just to firm up, like just cross your T's, dot your I's, is just to track your hours. Just because it's just a higher, more chance for that to get audited when you have like real estate professional status. You're checked as an active on your rentals. So just have the log at least. That's what I always tell folks. Like it's more or less duh. Yeah, I'm a realtor. That's all I do. But it's just like having like just the paperwork to show for it.
We have a few here about remote investing that we already answered. So we're going to skip those. Okay, here's an interesting one. Going to the 250K primary home owner exclusion or primary home exclusion. How many times can you use it in a lifetime? That's part 1 of the question. Then part 2 is, can you use it in 2 consecutive years?
Ooh, so I guess part 1, I mean, as long as you keep on, you can take as many as you can. I mean, you just got to live a long life. So 100 years, probably start buying homes when you're 20, divide by 4, is that 40 times? Yeah. Knock on wood, you live longer than 100 though. So, and then the second part, you said 2 consecutive years, huh?
Yeah, I guess multiple. I feel like that will trigger an audit.
Yeah, because it's like 2.
I haven't been audited. This would probably trigger an audit.
Yeah, it's 2 of 5 years. You would have to have that as your primary residence. I think because of that 2, by definition, I think because it's 2, I think you can't. Yeah.
Well, could you? Because it's not 2 consecutive, right? It's just 2 total.
2 of 5 years. So say if I lived at this home for 2 years, then I moved to another place. Oh no, I think you could pull it off, because say if I lived here for 2, like I lived here 5 of 5 years. I moved to another home. I sold it this year, and then I was in the other home. I had to move the prior year. So in the other new home for 2 years. Yeah, they actually, you can, speaking out loud. Yeah.
Good. It seems like a lot of moving.
I gotta get kudos to that person. You're creative, my friend. I like it.
But I mean, that will be 500K profit, potentially tax-free.
Tax
In
free, yeah. Get married too. I mean, you could exempt 500 per house then. Yeah.
all right. Please do not go and get married on account of the knowledge you're getting today, please.
I know, right? Right. That's that year-end tax planning joke is always get
Yeah.
married.
I actually have a friend. Him and his wife are both CPAs,
Uh-huh.
and they got married in secret. They were gonna get married like in May of the following year. They got married in like November and didn't tell anyone, just for tax purposes for that year.
Nice.
So they
Wait.
still had a wedding and everything, like a ceremony, and that's when the
Oh.
family found out that they were legally married the year before.
Oh, because people are like, yeah, when did this happen, right?
Yeah, well, they wanted a big wedding, so we can't tell people we went to the courthouse, but they did it. I mean, they were gonna get married no matter what, but they did it for tax purposes. So.
Yeah, yeah.
I think we've covered all the questions.
Oh, solid.
Make sure we got to all of them. Also, if you have any questions, this is the time because we are about to be over in like 5 minutes. So make sure you get your questions in.
Oh, okay, yeah. I'll find my charger.
Okay. And all right, we talked about holding property in an LLC versus personal name. That's more for liability protection. And then you gave a really good example on like taxes in California on income. So we actually had a question on that specifically. So we've already answered that, which is great. In the few minutes we have left, could we talk a little bit about, we've talked a lot about bookkeeping, but could we talk a little bit about what are some things that people could do? Like if I decided, you know what, Tony, you're going to be my guy going forward.
Let me try to find my charger quick.
Oh, no. You can hear me though, right?
Yep, I can hear you. Yeah.
All right, Tony, you're going to be my go-to. You're going to be my CPA from now on. What can I do to make your life a lot easier come tax time? Like, what can I do as an investor, as your client, so that my bookkeeping is so clean that you go, oh, this is easy. Let's
Yeah. One, actually have the bookkeeping in place. So most of the times people don't have the bookkeeping at all. So actually before year end, go ahead and do your bookkeeping. And it's as easy as just a spreadsheet, pull up your bank account, know all the expenses, or just reach out to a bookkeeper, right? The bookkeeper should be able to get you cleaned up pretty fast. So as simple as that. And then having all your closing docs for your new property. So that would be your other big thing. Just having all the closing docs, so you know, hey, any prepaid interest, prepaid insurance, those are commonly missed items.
Okay, so prepays specifically, are those possible deductions that people miss? Or
Oh yeah. It's commonly missed because of they just don't know where to look. So we know where to look because it's all baked into closing disclosure. But it's like you paid for it, so you just gotta make sure you use it now.
Okay, interesting. How does that work if you're converting your primary to a rental? Can you take those prepaids, like everything that went into escrow, and put it as an expense from the past, or is it just going forward?
Just going forward.
Forward.
Yep.
Cool. All right. Well, we're not getting any more questions, and we're at time. Tony, do you want to take? I know you talked a little bit about your practice in the beginning, but do you want to take a few seconds to maybe share like 3 things that maybe we didn't cover that you like to talk about, 3 things that you want people to walk away with, and then free license to do a full pitch of your services and tell people how to contact you? I think this question about the S Corp is a great question to send your way.
Oh yeah.
So, Mary, we'll make sure you can get in contact with Tony.
Yeah, I think so. The first one from a takeaway is like, if you're starting to invest in these properties, you know, just having your asset protection. I know, Jonathan, you mentioned that you're heavy on it, right? Truly, like, do it the right way. So transferring title, commingling funds, those are 2 main issues that I always see. So if you're going to invest, do it right. Yes, it's a few thousand extra dollars. It's not fun, but do you want to lose the whole thing, the whole pie from before? So watch out there. 2 is just do tax planning. So I kind of say tax planning is similar to a blueprint for the home. You know, planning on your finances, your workout plans. You need some plan, So what a tax plan simply does is like, hey, review everything that you have. Are you paying the least amount of taxes possible with the cards that you're dealt? So if you're dealt 7-2, aka W-2 only, you can just go home. You're done. But if you have rental units, can you project out how much you're actually going to pay or how much of a loss on a tax side, and seeing, hey, are you maximizing the most out of it? Do you want to dive into one of those three things that we talked about today, the less than 150K, real estate professional, short-term rental loophole? What can that get optimized? Big thing on charity. That's a big thing we do from tax planning. So have some tax plan in place. At least you know what direction you're headed towards. And then the third thing would just be bookkeeping and receipts. I think it's just, for some reason, like every April or March, I tell people, hey, like, can I get your profit and loss for your statement? Nothing. And I was like, oh boy, that's not gonna be good. And they scrap it together, they put it together, but it's just easier to be like, hey, get a dedicated bank account, get a dedicated credit card for the unit, and then link it into a QuickBooks or Wave Apps, or Stessa's free actually. Yeah, Stessa.com. It's assets spelled backwards. So it's a free tool that you can use. So for rental, it's made for rentals also. So use that tool, it's free. And just have that done, and the receipts, just because I'm a little bit more wary that now that the IRS has got more funding again to actually enforce some more items. So before, pretty much over the last decade, they just lost more people and lost more money. And then this whole big push to get 87,000 more new agents, it's more so to bring them back 10 years ago. So enforcement's going to be there again. So just having your receipts ready to go. What I tell people is just like, hey, take a picture, drop it in the Google Drive folder, forget about it. One day you'll need it, but at least, you don't have to like perfectly hyperlink it. If you have time, though, hyperlink it. So those would be things. Just have your ducks ready just in case it ever happens. Tax planning, what direction you're headed towards, what's your next year's income. What can you do to reduce your taxable income? There's always ways. It's just got to make sure you know how to play the tax game. So big things always like, real estate, small businesses, charity, big three umbrella. And then, just make sure you're invested, protect yourself. I literally had a client today. I finally caught up on an email from 2 days ago. Unfortunately, her mother passed away. And then she said that she's going through probate because her mother didn't have a will. And it's just like, more money wasted than needed to be if you just took the time to set up your trust, set up your LLCs right, set up your will. So just those are the three main takeaways I'd say for everyone, in the real estate game.
Cool. Awesome. That was very comprehensive. I really appreciate that.
Yeah, for sure.
Awesome. I took a lot of notes. I learned a lot. So
good. Yeah, I got one person who learned something today. Hopefully,
there's at least like 45 that were on currently at one point. I got something out. Cool. So so if I wanted to get in touch with you, well, I know your contact info, but if someone in the audience wanted to get in touch with you, what's your preferred method?
Oh yeah, just go to our website, thecpadude.com. Super easy. You can submit a form there. So that's the best way to reach us. But then I know some people don't like going to forums and whatnot. If not, you can just text me at 928 CPA Dude. So those are a couple ways. And then TikTok, Instagram, we always answer there too. And that's also the CPA Dude.
I've watched most of your TikToks at this point.
Oh, thank you.
Thank you. Cool. Well, we are now over time. I know you have another commitment, so we'll let you go. Thank you so much for your time and sharing your knowledge. This is the last webinar in this series, Real Estate Investing Bootcamp. There'll be more content. We'll publish out the schedule in the next couple of weeks. I think our next session is going to be focused on short-term rentals, so be on the lookout for that. Tony, I'll make sure you get a link. If there's any questions, I think we got to all the questions. If you have any other pending questions, please reach out to Tony directly at thecpadude.com. And as always, if you have a deal you're working on, reach out to Beeline. I have a slide for this actually, hold on, with the website. Go to thatmakeabeeline.com/question, and we'll get you in touch with the right person to answer your specific scenario. Thank you again, everyone. Thank you, Tony, and everybody have a good evening.
All right. Thank you. Have a good one.
You too. Bye.